Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of S&P Global Inc., ticker symbol SPGI. S&P Global is the largest credit rating agency in the world. Together with Moody's and Fitch, they operate an oligopoly in the American credit rating industry. They are also one of the largest positions from Chuck Akre's Akre Capital Management, which is fully focused on what he terms the three-legged stool, focused solely on long-term compounders. At the time of recording today's video, S&P Global is trading for $347.63 per share. Year to date, their stock price is down 26%. Over the past year, they're down 22.5%. Going back 5 years, however, they're up at a rate of 18% compounded annually. Over 10 years, they're up at a rate of 21% compounded annually. And going back prior to the global financial crisis, they're up at a rate of about 12% compounded annually. Also, keep in mind that this rate of return is not including dividends. S&P Global currently has about a 1% dividend yield, so that's in addition to this compounded annual rate of return in their stock price. So S&P is down more than $140 from their 52-week high. They're about $30 over their 52-week low. They have quite a bit of short interest for a company of their size. They have 3.8% of their shares outstanding currently sold short, and they have a market cap of $116 billion. So for some background about S&P Global, they operate in the financial services industry, specifically within the capital markets. S&P Global provides data and benchmark to capital and commodity market participants. In 2021, excluding IHS Markit, S&P Ratings was over 45% of the firm's revenues and over 55% of the firm's operating income. S&P Ratings is the largest credit rating agency in the world. The firm's other segments include market intelligence and indices, as well as Platts. Market intelligence provides desktop tools and other data solutions to investment banks, corporations, and other entities. Indices provides benchmarks for financial markets and is monetized through subscriptions, asset-based fees, and transaction-based royalties. Platts provides benchmarks to commodity markets, principally petroleum. S&P Global Inc. was founded in 1860 and is headquartered in New York, New York. So for our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of S&P Global based off of their business fundamentals. This analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. So with that said, let's get right into our analysis. Starting off with our first metric, we want their average return on capital over the last 5 years to be above 14%. Looking at S&P Global here, they blow this mark out of the water. In all 5 of these years, they've had returns on capital that are above 40%. And averaged out, they're earning a 45.5% return on capital, which is more than 3 times the metric we were looking for, and that's more than 6 times as good as the average business. An average publicly listed business earns about a 7% return on capital. The reason this is so important here is that over the long run, a stock is going to return approximately what its underlying business returns, and these underlying business returns are going to be captured here by return on capital. It's really great to see here that S&P Global has such gaudy return on capital numbers. So this is a huge check to start off on our first metric. Metric number 2, we want their revenues, net incomes, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these have gone up, and this will be a check, or even if one of them has gone down, this will be an X. So over the last 5 years, they've grown revenues from more than $6 billion to about $8.3 billion. They've also more than doubled their net incomes, and they've just about doubled their free cash flows as well. So this is another check here on metric number 2. Solid to see strong growth in S&P Global. Next up, metric number 3, we're looking for earning per share growth over the last 5 years. So this is building off of our previous metric, but here we're taking a look at the business on a per share basis, so from the perspective of an individual shareholder. This metric is encompassing both their earnings as well as their shares outstanding. So while their earnings have almost doubled over this time frame, their earnings per share have more than doubled. So this signals to us that the business has also been buying back shares over this time period. It is true that over their last 5 fiscal years, they have been buying back shares. If we take a look at their weighted shares outstanding, they were decreasing all the way through fiscal 2021. However, as part of their merger with IHS Markit, S&P actually issued more than 33 million shares, so that brings their total share count outstanding to about 275 million shares outstanding, which is higher than it was in 2017 when they had just under 260 million shares outstanding. So nevertheless, they're still growing their earnings per share. So actually encompassing all the way up until the present day, they've diluted shareholders over the last 5 years. So this metric is still going to be a check, but that's just something to note there. Similar situation for metric number 4, we're looking for free cash flow per share growth over the last 5 years. Again, during these 5 fiscal years, this number looks excellent, and it shows a growth rate that's been higher than their actual free cash flow growth, which again signals those share buybacks, but they've issued these additional shares to complete that merger. So that is something that you'd want to do more research about there to really understand if that merger is going to add value to S&P Global. So really, shares outstanding are important because when you're purchasing a share of stock in a business, what you're really buying is a fractional ownership percentage in that business. So when a business is issuing new shares, whether to raise capital as part of incentive plans or to make acquisitions, they're decreasing your ownership percentage in the business, which is ultimately going to decrease the percentage of the business's profits that you're going to be entitled to. While those profits may or may not go up, your percentage ownership of them is going to go down with more shares outstanding. So for metric number 4, this one's also going to be a check. The other thing to note here is that over long periods of time, earnings and free cash flows should be about the same for a business. So to recap where we stand so far, through 4 metrics, we've got 4 checks and no X's. Let's keep going. Next up, for metric number 5, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below the amount of free cash flow that they produced in the last 5 years. So at the end of fiscal 2021, S&P Global had negative net debt, meaning that after subtracting all of their liabilities, they were left over with $1.5 billion of cash. However, because of their recent merger, they now have a net debt position of about $8 billion in net debt. So they spent quite a bit of money and had to issue shares as part of that merger. Over this time frame, even with $8 billion of net debt, they produced about $13.5 billion of free cash flow. So this is going to be a check on metric number 5. The business is not overly levered, and they're going to be able to use free cash flows in other aspects of their business. So free cash flow is the lifeblood of a business, and ultimately it can be used to make acquisitions, reinvest back into the business, buy back shares, pay down debt, or pay dividends. So it's good that their free cash flows, while they did add debt, are not exclusively going to be tied up in debt repayment. Then last but not least, our 6th and final metric, we want their average 5-year free cash flow relative to their enterprise value to give us a yield above 5%. This will give us a risk premium to the risk-free rate of the 10-year treasury. And by using total enterprise value here instead of their market cap, it'll give us a more realistic economic picture of the business as it'll take into account this debt load. Looking at their total enterprise value here on this chart, we can see that their total enterprise value dramatically increased in late February when they finalized their merger. So currently, S&P Global has a total enterprise value of $127 billion. Over the last 5 years, they produced $13.5 billion of free cash flow, which means that in an average year, they're producing about $2.7 billion of free cash flow. So when we divide their average free cash flow of $2.7 billion by their total enterprise value of $127 billion, that's only going to give us an average 5-year free cash flow to enterprise value yield of a little over 2%. This is going to be under what the current risk-free rate is, and so this is below that 5% metric. This is our one and only X on metric number 6 here. Here we're taking a look at S&P Global's dividend profile. Oftentimes, people blindly chase dividend yield or these dividend track records from dividend aristocrats or dividend kings. In the case of S&P Global, they are actually a dividend aristocrat. They've increased their dividend payments in each of the past 49 years, which puts them 1 year away from becoming a dividend king, which would put them in select company with other businesses such as Coca-Cola, Procter & Gamble, and Johnson & Johnson for having 50 years of annual increasing dividend payments. So for S&P Global, they've almost doubled their dividend payments in the last 5 years alone. Over the same time frame, they've pretty much doubled their cash flows, so they are still paying out a very small proportion of their cash flows as dividends overall, which gives them plenty of room to spare if their cash flows continue on into the future, which seems pretty likely, to be able to keep increasing this dividend for a long runway ahead. That's not necessarily a guarantee, but based off their historical numbers here, it looks relatively likely. Then finally, here we are using a discounted cash flow model to come to a potential fair value for S&P Global. Based off their average 5-year free cash flows per share, that number is about $11 currently. Projecting that out for a growth stage for the next 10 years at a historical growth rate of 9.6%, which is the growth rate that they've been able to grow their free cash flows for the past 30 years. Then using a terminal stage 10 years out after that, where that growth rate is cut more than half to only 4%. So projecting S&P Global out for the next 20 years and having a discount rate or a required rate of return of 10%, then it currently looks like a fair value for the business if you want a 10% rate of return is around $188 per share. So we're not adding in their tangible book value here. That's very negative because of how the accounting is done for their share buybacks. So this is based off their historical growth numbers, so this gives us just a baseline projection into the future. At today's current prices, it looks like you could reasonably expect about a 3% rate of return going forward, including their dividends, if you found out that these historical growth assumptions were accurate. So you have to either confirm or disconfirm these for yourself. This type of analysis and this discounted cash flow model are not financial advice. They are not a buy or sell recommendation of any security. Before making any sort of investment, it's important to consult with the properly registered financial and legal professionals. Instead, this video serves as a holistic and beginning understanding of S&P Global to determine whether it's worth your while to dig in and learn more about the business. I highly recommend that if you're interested in the business, you both read through the company's 10Ks as well as their recent earnings calls to get a deeper understanding and a more nuanced perspective of the business. You can understand a multitude of things, such as some of the business's risks, the environment the business operates in, and management's approach to capital allocation going forward into the future. So in summary, S&P Global checks the box on 5 out of our 6 metrics. By almost all accounts, it looks like the business is a wonderful business. They produce really high returns on capital. They've been able to grow their earnings, revenues, and free cash flows. They did just make a big splurge on an acquisition of IHS Markit. So that's something that you definitely want to dive into and understand if that's going to create value for existing shareholders of S&P Global. Even with that acquisition, while they have both diluted shareholders and raised additional debt, they're still producing enough cash flow to be able to cover that debt and then some. However, based off their total enterprise value, it looks like the fact that S&P Global is such a wonderful business is being fully appreciated by the market right now. Their average free cash flow return compared to their enterprise value is below the risk-free rate of the 10-year treasury. Typically, both bonds and businesses are going to have a risk premium to the treasury yield, just so that it makes it worth your while to be interested in the company, as there are more risks involved there. Then we also learned about their dividend profile. S&P is a dividend aristocrat of 49 years that's knocking on the door of becoming a dividend king. It looks like, based on their abilities to produce free cash flows, they've got plenty of room to keep expanding their dividend into the future. And lastly, we found out that through our discounted cash flow analysis, which was based off of their historical growth assumptions for free cash flow over the past 30 years, that S&P Global looks like it is richly valued today. You could reasonably expect about a 3% rate of return from today's prices over the next 20 years if those historical growth metrics held true for the next 20 years. If, again, using those historical growth assumptions, which you need to validate or invalidate for yourself, you wanted a 10% rate of return from S&P Global, then you'd have to wait for the business's stock price to nearly fall in half from today's prices. The last time the business was trading in line with that mark was back in January of 2019. So these things do happen. You just have to be patient. Again, if you've done the work and you understand that those assumptions are accurate or not. Then to reiterate, this video and this analysis are not financial advice in any way, shape, or form. They are not a buy or sell recommendation of any security. And before making any sort of investment decision, it's vitally important that you consult with the properly registered financial and legal professionals. So with that said, that's it for today's fundamental stock analysis of S&P Global Inc., ticker symbol SPGI. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about S&P Global with me, and have a great day.